Well, welcome back to the Central Arizona VITA Network 2021 VITA training for volunteers. We will now continue on for the last segment of session 2 and discuss income. Here's our PowerPoint again, and so we'll get started back into it. And then, so now we're going to start talking. Gene just went over that formula with you that said, hey, you start with income, and then there's certain adjustments to income that then leave you at adjusted gross income. And for those of you who have ever filed a mortgage application or student loans or FAFSA forms, you know, AGI, that adjusted gross income, is a pretty popular figure in taxes that they look at. But then you get to take deductions off of that before you get to taxable income. So we're going to start now. We're going to cover all of those things in the next few segments of this, starting with income right now. And here's the general rule for income. And it's all encompassing. All income is taxable, no matter how you get it. Anything that makes you better off financially is taxable, unless it is specifically excluded by the tax law. So we're going to show you some examples of, it's really easier, it's way easier to find the things that are excluded than to figure out whether all the things that are included. Because I would tell you, if you're walking down the street and you find $20 on the sidewalk, that's income. There's no exclusion for found money. Okay. There are some exclusions, and we'll go over the main important ones here in just a second. So right here are examples of taxable income. And this is what I said. This is in your 4012. This is, I forget which tab this is in, tab D, I think. I don't remember exactly, but there's a whole tab dedicated to income. And as I said, there's a lot of things that are income, but what's easier is in the next page are examples of taxable income. Now, there's still quite a few. I'm going to right here just talk about the ones that we commonly come into that we commonly face. So first of all, child support. Okay. You're going to hear this a couple of times, but child support is not taxable income. Okay. If they get civil damages or other monetary award, this is from a court. You know, they get an award from a court. Most awards from a court are not taxable, except if they're punitive damages. Now, usually you don't see punitive damages unless they're like these big awards you hear about. You know, they won a $2 million lawsuit. Those are usually punitive awards. Most of the time, the awards you're getting are what we call compensatory. They're to compensate you for personal injury or sickness or something like that, and it's not taxable. Okay. Damages, death payments, or life insurance. So if you get a life insurance from, you know, your dad or something or whatever, I shouldn't draw examples because they're they're bleak, but life insurance proceeds are not taxable. The dividends on life insurance are not taxable, but that. Federal income tax refunds. Now, they're not taxable at the federal level. There's a general concept in the tax law is that you don't pay tax twice on the same dollar. And if you're getting a refund of taxes you've already paid, well, you've already paid tax on that money. So they're not going to tax you again. We're going to talk about state income tax refunds a little later. Okay. Here's a big one, or two big ones: gifts and inheritances. Okay, so, you know, if somebody gives you money, it's not taxable to you. If you get an inheritance, it's not taxable. Some of you who maybe might come from wealthy families, you've heard about the estate and gift tax, and there could be a gift tax to the donor, to the person who gives it to you, but that's only if they're really extremely wealthy. Okay, and I'm talking like over 12 million bucks, right? Net worth. Okay. Let's see. Interest on certain government bonds are not taxable. let's see. Oh, Social Security benefits down here. Okay. In general, if you don't make a lot of other income, they're never taxable. But if you make enough other income, a portion may be taxable. Okay. And we're going to see that when you do your, when you take the certification test and you do those practice lab returns, there's one of those things to where there, one of the fact patterns, there was enough other income to make the Social Security partially taxable. Here's the good news is the tax software will figure that out for you. You don't really have to calculate that. Supplemental Social Security, supplemental security income is for very low income families, temporary assistance for needy families. You think of food stamps, those aren't. Welfare payments aren't taxable. Those are the main things that we run into that you could do. But something I haven't told you is that through all of these charts, you'll always see these little footnotes down in here, right? I mean, like, where's footnote 1? Oh, right here. No, that's not a 1. I can't see it. But I want you to pay attention to this footnote right here. If a taxpayer received Form 1099-C, cancellation of debt in relation to their main home, it may not be taxable. But what I wanted to point out to you is if they receive a 1099-C for cancellation of debt that is not in relation to their main home, do you see any exclusion up above for that? So in other words, what this is saying is like, if you get a credit card company and they finally agree that, hey, you're just not going to be able to pay this off, and they cancel the debt, you don't have to pay it back. Is it taxable? And I'm going to reiterate, everything's taxable unless you see it excluded up here, and it's not excluded. I mean, kind of talk about kicking you when you're down, but here's the concept, and this will illustrate it. Remember I said earlier, everything that makes you better off. So if the credit card company cancels your debt and you don't have to pay them $5,000, it's as if somebody gave you $5,000 to pay off your debts. So it is taxable, and one of your software, one of your tax returns is going to have a 1099-C on that. So I wanted to put that. So now when we talk about taxable and non-taxable income, we're going to also have two kind of sub-classifications of what we call earned income and unearned income. So earned income is kind of what it says. You had to do something for it, right? You know, you worked for it, or you went into business for yourself. You performed some kind of services for it, whatever. You did something to earn it, right? Unearned income are things like interest and dividends. You know, you got a bank account or some stock accounts and it pays you interest and dividends. You didn't really have to go to work for that. I mean, your money had to go to work, but not you, right? Retirement income. And hey, you could argue, well, you know, like right now I'm getting a pension from Arizona State Retirement System, and I worked over 20 years for that. But right now I'm not working at that. So I'm not, that's the work I did was in the past for that. So I have to pay tax on that pension. Social Security is unearned income, and same thing. So unemployment benefits. And I mean, I know you might say, well, yeah, I couldn't get unemployment if I didn't work, but it's not. It's unearned income. By the way, I just thought of an exception. I showed you that chart of what was non-taxable. And many of you may have heard this in the news, but I'm talking now about unemployment benefits. In general, and for 2021, for this year, if you get unemployment, it's taxable. I mean, talk about kicking you when you're down, right? In 2020, part of the CARES Act, it made the first $10,200 of it non-taxable, but that was only for 2020. So don't, you know, you may have heard about that. Don't confuse that. There's nothing up in that chart I just showed you that said unemployment was non-taxable. It's taxable. Alimony is unearned income. Child support is unearned income. And then here we're going to see a lot about this last one a little bit later, where we talk about scholarships that exceed educational expenses. If you get a scholarship, and as long as you use that scholarship to pay educational expenses, and they're qualified educational expenses, I won't give you the definition, that scholarship is not taxable. However, say you get a $10,000 scholarship and your tuition, books, and supplies were only $5,000, you've got to pay tax on that extra $5,000. And it is called unearned income. So it's not going to help you with it. And the reason why we classify these things into earned and unearned income, there's a variety of reasons. The ones that affect us most is because that unearned income doesn't count towards the earned income tax credit. You can't use it. So that's one of the big things. There's a lot of other reasons when you get kind of wealthy and you've got things like we have passive income generators and things like that. There's that it could affect, but we'll save that for now. So here's kind of some questions for you to think about. Tony received the following types of income. Which income is exempt from federal taxes? So if you're at home and if you have that book, the 4012, you can pull up that chart that I showed you, or you can kind of try to remember it. But remember, I did point out one of these things. And if you remember what I said, it was inheritance. Inheritances aren't taxable. Not to the recipient. Sometimes for the person who dies, there's something called the estate and gift tax, but that really only affects really rich people. Like if they leave an estate, a taxable estate of over 12 million, so I don't know about you guys, but that I don't see that coming in my future anywhere. But so an inheritance you get is not going to be taxable. So here, this is the screen and tax layer that shows you all of the different income. Here's where you're going to go enter wages and salaries, the W-2, or state and local refunds. There's a small place where maybe your state refund is taxable, and this gives you a worksheet for doing it. We do see a lot of interest in dividends. We do see pension distributions, 1099-Rs, and that. Here's the unemployment compensation that you would do. Form 1099 miscellaneous. That was, well, we're going to get into explaining that. Don't let me try to explain it now. Profit and loss from a business. This is just the screen where we're going to start talking about all of these income items here in the next, I don't know if we'll get through with it today, but we're going to try. But Gene already told you this, out of scope. This is farming, but as Gene says, he's never seen one. I've been doing taxes over 25 years. I've never seen one either. So not likely we're going to see one of those. So let's talk about the types of income that you can have. W-2 wages and salaries. Tip income. And there's some tip income that will be shown on a W-2. There's some tip income that won't. They may get cash tips on that. Are cash tips taxable? And I know I don't mean for you to turn on your things and answer it. I'm just asking you to reflect. And the answer is yes. They're not up in that excludable thing. Now, I will tell you that there'll be people who might come in and say, well, I don't have to pay tax on that. That's a gift. And I would tell you, I grew up in Las Vegas, and the dealers in Las Vegas, they took a lawsuit like almost all the way to the Supreme Court. Okay. Because they said, oh, these tips we get are gifts from the gamblers because we gave them luck. Right. And they fought it all the way and lost. Tips are taxable in whatever shape, form, or whatever they come in. More and more we're finding when we show you on the W-2, more and more, in the food and beverage industry, they're getting claimed because, the waiter or waitress is supposed to report their cash tips, but B, the majority of tips are coming through on a credit card, and they get captured pretty much automatically. There's dependent care benefits. This is kind of odd, so I'm really not going to talk about this, but there's a special type of dependent care benefits that would be taxable unless you have no. I'm thinking of something else. Sorry. Dependent care benefits that come on your W-2, that's where your employer paid for childcare. And it may or may not be taxable. It would be unless you can show that you paid those child care expenses elsewhere. And we're going to get into that in a bit. But again, this stuff is all considered earned income. I already talked about scholarships, so I'm going to skip this one for a little bit. We'll talk about qualified expenses a little later. Okay, so here is what Gene had kind of told you. This is we're going to see all kinds of forms: W-2s, 1099-Rs, 1099 INTs, 1099 DIVs, 1099 essays. We input any and all information from the document. If you see it, key it. And you're going to find in the tax layer forms, they kind of model the forms. You know, IRS says, hey, you got to report it in this certain format. And they come looking a little different, but they all will say like box 1A, wages, box 3, federal tax withholding, box 10, this. And even in tax layer, it'll say 1099 DIV, box 1, 1099 DIV, box 5. You know, you just got to match up. Oh, it's in box 1. We put it in box 1 on this form, right? Just if it's on the form, put it in the tax software. And 99 times out of 100, or at least 9 out of 10, tax layer is going to treat it properly. I like to tell about this point in time when we're going to start talking about documents that we're going to input into tax layer. I like to start having all of you think, and it won't be easy at first, but this is how I think about it. When I'm inputting information into a return, I'm almost envisioning what that return is going to look like when I get done. Because then when I get done, I pull up the return and I look at it and I see, oh, okay, I expected that. Yeah, I know where that came from. Oh, where did this come from? And I go back and I check my input. Or, hey, that shouldn't be that high. And I go check my input. And it's just a good habit. You're not going to get good at it until you do a few of them, but it's a good habit to be thinking about because it'll help you not miss stuff. Because sometimes you'll go through the finished return, say, why didn't I get that credit? And it might just be because of a little box you forgot to check on tax layer, right? So I just kind of wanted to put that out to you here. So sorry about that. Here's a simple W-2. You know, but let's talk about it. Here, see these boxes, box 1 here, box 3 here, box 5. On the tax layer input form, it won't really look like this W-2, but it'll have lines and it'll say this is box 1, wages, tips, and compensation, box 2, federal income tax withheld. So you just got to match up the boxes with the input form on tax layer. But let's look at this. This is common. Here you got wages and other compensation, federal income tax withheld. Look at this. Why is the Social Security wages higher than the taxable wages up there? Now, I think you all know what Social Security is and what Medicare is, right? But the answer to that is look at down here at all of these boxes down here, okay? I know that DD is for health insurance. I know that W is for I thought I knew what W for. Dependent and child care or no?
Health savings account.
Health savings account. Thank you. I knew it. And I don't even know what E is for. Now, and you don't really need to know. You can just key it into tax layer. But if you're curious, there is a section. Well, okay, first of all, if you're sitting there keying this in, on your W-2, you turn it over. And as long as you're not old and have eyes like me, or you get a big magnifying glass, it'll tell you what all those codes are. But you could also look in the 4012, and there's a page in the 4012 that'll tell you what all those are for. But why you see a difference in here is some of this stuff is subject to Social Security tax, like, and some of it is not subject to income tax. So that's why you get this discrepancy in here. Now, here's another thing. You see the Social Security tips in here? This is because the waiter told, assuming, what is this? Okay, county school. I don't know why they would be getting tips at a county school, but nevertheless, maybe they work in the cafeteria at school. I don't know, but whatever. They told their employer that they received $1,097 of tips, and their employer added it in to here and here. you'll see a box, and sometimes we'll see, it's not often we see this, allocated tips. And what this allocated tips box is for is back in the Reagan Tax Act. And, you know, okay, I'm not going to say this on tape or anything like that, but I used to be a waiter when I went through college, right? And back in the days, you know, I'm not saying I didn't claim all my tips, but there were people who didn't claim all their tips. In fact, there were a lot of people who didn't claim all their tips. And the Reagan, you know, when he did the Tax Act, they knew that that was a lost source of income. So they put into the law, they said for large employers like, you know, hotels and stuff like that, if your aggregate reported tips don't equal at least 7% of your gross sales, then we're assuming that there were cash tips that are being escaped, you know, that are not being paid. You're going to have to allocate those tips evenly among all your employees. And so that's where you would see this box. Oh, here's the dependent care benefits that would show up. Okay. So anyway, all of these things, you're going to fill it in just exactly like this. Down here is the state information. Okay. So that's a W-2 there. Here's what I was just kind of explaining about the reported tips and the allocated tips there. And then I think we already showed you on this, if the client had an ITIN that, you know, it starts with a 9, remember, we're going to put this in down here on that. This is the W-2 screen right up here. We're going to put it in there. Okay. 1099-G, this is for state and local tax refunds. First of all, Arizona is not sending these out anymore. Okay. I'm going to back up and I'm going to explain a broad concept here too. If we showed you that formula about deductions, and I'm going to jump ahead a little bit so that you understand this part. Usually you can take either a standard deduction, which is a set amount that the government gives you. You don't have to prove a thing. They just assume you gave some gifts to charity and you paid taxes and you did this, and we're going to give everybody this set amount unless you can itemize certain deductions that come to more than the standard deduction. And we're going to go over those itemized deductions, but they're things like state taxes would be a deduction. Again, you don't have to pay tax twice on the same thing was the idea. Charitable contributions, real estate taxes, medical charges, but only if they exceed a certain percentage of it. Those are types of things that are itemized deductions. Now, here's the reality. 9 out of 10 taxpayers, and I bet for our clients, it's more like, it's probably higher than that now. The Trump Act, when he took it, they doubled the standard deductions. And we hardly see anybody that itemizes deductions. But now that you get that idea in your head, if on the prior year return, somebody itemized deductions, and they deducted the state taxes paid, and then they get a refund of those state taxes paid. Well, what that's saying is, well, you shouldn't have really deducted them in the first place. But you don't know what your tax liability is going to be, or you don't know what your state, you know, what your real state tax liability is going to be till you get all done with everything else. So what IRS says, okay, we get it. We'll just let you deduct any tax that you paid, state tax that you paid. You can deduct it in this year, but if you get a refund back from it, you got to pay income tax on that state tax refund. Now, here's the exception. If you took the standard deduction and you get a tax refund, you never have to pay tax on it. And this is going to be 90% of our returns. Okay, but one thing, if you do see that they got a state tax refund and there's a little checkbox on the intake and interview, you've got to say, you've got to ask them, did you itemize deductions last year? Half the time they're not going to know. Okay, and we really try to encourage folks to bring in their prior year return. And if they did, then you just look at their prior year return and that answers it for you right away. But if they did itemized taxes on their prior year return and they got a refund, it's not necessarily taxable. It's only taxable if they got the benefit of the deduction. And that's because then there's this whole worksheet, and I'll spare you the math that goes into it. But the whole worksheet is saying, well, what if they would have taken the standard deduction and they only got like $100 more by itemizing, and they got a $300 refund? Well, hey, not all of that refund should be taxable. That's called the tax benefit rule. And luckily, you don't need to worry about it. You just got to put in the right things into TaxSlayer and it's going to calculate it. Okay, it's really pretty easy. Bottom line here that I want to see is if they did not deduct, if they did not itemize deductions on their prior year return, the state tax refund is never taxable. That's the big thing you got to remember right there. Here's what this would look like, except as I said, Arizona stopped sending these out. You have to go request them now. But if you would have got it, it would show up, and taxpayers, you get a few diligent ones that will go log on to the Department of Revenue, the Arizona State Department of Revenue, and they can download the 1099-G, and they may bring it in, and it would show you right here in this box that they had gotten the state or local income tax refund. While we're on this form, if they got unemployment, well, again, our Department of Economic Security, they don't report it on this form, they give you a letter. But if it was from another state, it would usually be reported on this form in box 1. Hang in there, you guys. I know that this is a lot of information, and as I told you at the beginning of this, just absorb it. You'll really start learning more of it as you prepare tax returns, and it'll sink in a lot more. Okay. So this is a quick version look at the TaxSlayer screen where they did itemize deductions in the prior year and they got a state tax refund. Then you have to go in here and you've got to fill in these fields, and then the tax software is going to calculate whether they have to claim any part of that tax refund as income or not. This again is part of that screen right there. So we're going to do that. So now we come to interest income, and I need to take a drink here real quick. Interest income can come from a variety of resources. It usually comes from amounts deposited in bank, savings and loans, or credit union. And those banks and stuff, if the interest earned, and these days, I don't know about you guys, but we're not making much interest on our bank accounts. And if it's less than $10, they don't even have to send them a form. However, if they earned interest, they're supposed to tell us, and we're supposed to ask them, and we're supposed to report it. Might be $8, might be $9, so we should ask the question. Sometimes the interest could come on certificates of deposits or bonds, and those are usually more bigger amounts of interest. And usually then you're going to get something called a 1099 INT for interest. It could also come from debts owed. I've had clients that lent money to people for second mortgages, and they got interest on that. That's interest income to them. So you always ask if they had any interest income on their returns. This is what a 1099 INT looks like. And there's a variety of boxes on here, a few things that I'm going to kind of go over. Right here, it shows in box 1, here's the interest income that Moneybags Bank paid to them. Look at box 2 here. This is an early withdrawal penalty. You don't see it often because usually that's when they've cashed in a CD before it matured. And that's what they call an early withdrawal penalty. But that early withdrawal penalty, we're going to see in the next segment here, is an adjustment to income. And the reason I'm focusing on this is because in your practice lab returns that you're going to do for the certification exam, there's one of these things that's got an early withdrawal penalty on it. So you got to make sure you key it in. But then the software takes care of it. Okay, it's just, if you see it, key it, right? This is a box where it says federal income tax withheld, and we overlook this a lot on these forms because some of these folks tell the bank or whatever, hey, I need you to withhold 20% tax on it or something like that. Another box right here is foreign tax paid. If this is a certificate of deposit in another country, that country may have assessed a tax on it. And remember that general rule I kind of told you about is that you don't pay tax twice on the same money. We will give a credit for the foreign tax paid. We, meaning the United States, IRS, will give it a tax credit so that you don't pay tax twice on the same money. So that's an important thing to kind of remember. Again, now here's the input screen that I was telling you that you would have here. And here, this is for interest income, a 1099 INT. There's that early withdrawal penalty. See where it says here, box 2, box 3. So all you got to do is just look at the form and put in the things that were in the boxes in there. It's really easy peasy, pretty simple. So here's something just to kind of reinforce your concept of interest. So Marie and her husband have 3 forms of 1099 INT. Oh, this is a tricky one. Careful, go careful on this. State of Washington bond interest for 300. Desert Financial Credit Union for 600, Western Savings and Loan for 960. Now, I would tell you if we were in a live class right now, probably almost all of you would just say, okay, yeah, add up those 3. 3 plus 6 is 900 plus 960 is, 1860. But if you go back and you look at that chart of what's non-taxable income, you're going to find out that state bond interest, that's the government bond interest I was telling you about, is not taxable. So the real answer to this is $1,560. Okay, so now this is for dividends. This is a 1099 DIV. Kind of looks like that INT one, except look here. Here we have ordinary dividends and qualified dividends. Now, no, they're not paying tax twice on the same thing. What we're saying on this form is that if it's a qualified dividend, and I won't explain exactly what that is, the brokerage is going to tell you what that is, but it's subject to the lower capital gains tax rate. They're saying of this portion of dividends, what portion was qualified? This will never be more than this, but sometimes it's less than that. So if you see it, key it, and the software is going to take care of everything to you. Most of these other things right in here, you will see this often, total capital gain distributions. Again, if you see it, key it, the tax software is going to take it. A lot of these other things in here, we never really see. And if you do see something like these right here, these 2, they're out of scope. They get really complicated. Yeah, but I don't think I've ever seen any of these in a VITA site, so don't think about it. Always watch for federal income tax withheld, and always watch for foreign tax paid. Again, here's the income. I'm sorry. Here's the input sheet for dividends, and I really just want to point out, of course, where you see the asterisk, the red asterisk, it means it's a required field that you have to put in. And then all of these little boxes right here, box 1A, 1B, they relate right up here to box 1A, box 1B. So it's just, you don't really even need to understand it. Just put it in, what you see. Okay. Now, here, let me go back up to this one. Here is a simple 1099 DIV. And I will be honest with you, we don't really see many of these that simple anymore, because the brokerage firms have all kind of run towards this, which I'm going to go down 2 slides and show you. You get a form that looks something like this, and they combine everything all into one form. What you have to look for is like in this thing, this came from Lucky Dog LLC, right? And it's in a different format, but it's got exactly the same thing. See over here on the left says box 1A, box 1B. Same thing as on that other form, gives you the title of it, tells you what it is. Okay. Same thing that's on the other form. But if I were to scroll on down this, then we're going to see, well, they have a section that says 1099 INT for interest, and then another one that says 1099B for brokerage statements. So they kind of combine them all into one. So be on the lookout, but don't be intimidated by it, because it's really just the same thing in a different format. Okay. Now, here we come to one that's called a 1099 miscellaneous. And prior to 2020, I'm still going to give you the history because maybe some of you may come in. Well, we still refer to things as that. When we used to have what's called non-employee compensation, this is where you worked as an independent contractor. And you've heard people talk about, oh yeah, he got 1099'd on that income that he did. He was mowing lawns for a guy. They called him an independent contractor. Usually what that meant is they'd get a 1099 miscellaneous, and then box 7 would show non-employee compensation. Well, last year, IRS decided to break out this 1099 miscellaneous that has all kinds of other income on it and break it out to where now there's 2 forms. There's a 1099 NEC for non-employee compensation. And then they turned box 7 on this form into be payer-made direct sales totaling $5,000 or more to consumer products to recipient for resale. I guess that's for the really good Amway guys or something like that. I haven't seen any of those, so I don't know what it is. But we will see these 1099 miscellaneouses. And some, by the way, if they come in as rents, right, it's going to be probably out of scope. Get your site coordinator to make sure. Okay. Royalties might be out of scope. Get your site coordinator just in case. We can do simple royalties that are on here. We can't do the more complex ones that go on that. But we will see a lot of them that say other income. And here's a common one we see is we do some Native American Indians. And a lot of you probably know they're getting what they call per capita payments from their proceeds from the gambling casinos on here. And whatever their proceeds are, they get a 1099 miscellaneous here. And it shows in a box that says other income in there. So we've got to know how to put that stuff in here. Here's that 1099 NEC, which they made this pretty simple. It's just one box, non-employee compensation. And this is what they're going to get. I'll give you a heads up here now. When they have this kind of income, they are now in business for themselves, and they have to file a Schedule C, which is income or loss from a business. So right away, that's going to tell us, hey, we're going to have a much more complicated return here, right? Actually, they're the more fun returns too. So, you know, this is one reason why we want to get you advanced certified. So if you get some simple ones of these, yeah, go ahead and do it and start getting your, you know, dipping your beak into the more fun ones. The basic ones can get kind of boring after you do 2 or 3 of them, you know, so, you know, you don't have to if you're not comfortable, and we will help you with them too if you decide you're going to do them. So, how are we doing on time? Good. 3:30. We got a half an hour left. So this is going quite well, really. I hope I'm not doing too much. Should I take a pause and see if we've had any questions before I start diving into Schedule Cs?
Well, Jim, we haven't had any questions on the chat so far.
Okay. Well, good. Then I'm going to keep going here. So as I've said, usually, you know, there's a question on the intake and interview form. You know, did you have any self-employment income? And sometimes they don't really realize what that is. But then you look through their papers and there you see a 1099 NEC. You know, some of these folks didn't really realize what was going on. They went and took a job and the employer said, hey, I don't really need to have you fill out the W4 here. We'll just treat you as an independent contractor. And then you can take care of your own taxes. I won't have to withhold taxes on your check, right? And, you know, right away, especially the guy who's been out of a job and just kind of looking and saying, yeah, okay, that sounds great. I will tell you right now, in the years that I've been a CPA, more people get into trouble with the IRS over this Schedule C income. And in a minute, I'm going to explain why, because there's a whole nother layer of tax gets layered on top of the regular income tax here. It's called self-employment tax. And I'll talk about that in a second. From this slide is showing us here that usually we see it on the 1099 NEC, but there may be cash receipts as well. So whenever you see a 1099 NEC or they say they have self-employment income, you need to ask them in the interview, well, is this the only income you made from this business? Oh, no, I also got some cash payments over here. Well, we need to claim them. And then here, let me give you an example of how this goes in an interview sometimes. And the taxpayer says, well, no, I was told that if I didn't make more than $600 from this person, I don't have to claim that. And then we've got to tell them, no, that's not what it says. What they meant to tell you is that if you made less than 600, they don't have to give you a 1099, but that doesn't mean you don't have to report it. And this is the point in time where hopefully, and more often than not, okay, most of the time they say, they kind of give you a sullen look and say, okay, well, we've got to do what's right. Sometimes you're going to get the person say, well, I'm not claiming it. Just forget I told you that. And I'm going to tell you right now, that's when you get the site coordinator, because we don't want to do those returns. It won't be an accurate return. And sometimes what I tell people is I say, you know, usually if I'm the site coordinator and I'll come over and try to be reasonable with them and not just say, no, we're not doing your return. I'm going to say, look, if you get audited with this, let me tell you the first place that they're going to go look. So they're going to look at your bank account. They're going to see if you got more money that went in your bank account than what's on your return. They're just going to assume it came from the business. And maybe it came from other places that wasn't business income. You should just report what's right. Our job is to help you find the deductions to help you lower that taxable income. And then usually they say, yeah, okay, you know, and so that's what I would do as a site coordinator. I would try to talk. But you know, when you start feeling uncomfortable, get the site coordinator. And this is one case where it sometimes happens, I will tell you. Okay, so know the difference between self-employment and one-time payments. You know, and generally, if they get the 1099 NEC, it means that they were self-employed, that they're going to be. There's some examples of one-time payments, maybe like those. I told you about the per capita payments that come up on box 3 of the 1099 miscellaneous. That's not self-employment income. They don't have to file a Schedule C on that. That just goes in a different place on the tax return. Okay, so doing that. So sufficient questions that you know to be satisfied is you're going to ask these questions of it. Did they actually conduct a business? You know, and I guess technically, you know, if they just did a one-off job for somebody and made $500, you know, and didn't, you know, there's a place in TaxSlayer, you know, and they say, I don't have any expenses for doing this. There's a place in TaxSlayer that we can claim it as other income, and we can check a box that says subject to self-employment tax, and we don't have to file a Schedule C if they don't have any expenses. But that's the rare occasion for it. But if you find that, get your site coordinator involved. We'll show you how to do it. The other thing that if they're running a business, that they have to have records to support income and expenses, or be able to reasonably reconstruct those income and expense records. And what I mean by that, you know, and more often than not, you're not going to have somebody come in here and say, oh yeah, here's my spreadsheet of all the income on the left side and all the expenses on the right, all nice and categorized by that. Sorry, you're not going to see that. Okay. You'll be lucky sometimes if they even come in with a box full of receipts. And if they do, it's not going to be our job to total all that up. We're going to usually send them away, say, look, go take these receipts and we're going to help you define categories. Go put them in categories, get on an adding machine, add it up, and come back with a list of your expenses for us. Okay. But here's what happens a lot too, is they say, oh, I didn't track any of that. And we don't want to just say, well, then we can't deduct it. Let's do your return and make them pay a whole lot of tax on money they don't owe. We tell them, look, go back and go through your bank account, go through your credit card statements, and look at anything that you had to spend to earn this money and jot it down. And then you can kind of categorize it. And we kind of teach them, usually we're going to have to send them away so that they can reconstruct their income and expense. And, you know, if they're doing it out of a bank account and a credit card, IRS will usually accept that at audit. I mean, if they didn't keep the paper receipts and keep a good filing cabinet or whatever. But we want to make sure that they claim those expenses. And so I'm going to pause right here and talk about why this is also important. So when you are self-employed, let me start. You're employed and you all know you got a paycheck, a pay stub. And on that pay stub says, oh, here's your gross earnings. Here's the federal income tax that we withheld, right? Here's the Social Security tax we withheld. Here's the Medicare tax we withheld. That Social Security and Medicare, I will tell you, they total to be 7.65% of your gross wages. And that's, you know, what that's for, right? The employer is matching that 7.65%. So a total of 15.3% is getting paid to Social Security in addition to the income tax. Now, it was withheld from your wages. You never really saw it. Most people, they just don't even factor it in. When you become self-employed, you not only have to pay income tax on the net profit of that business, you've got to pay the self-employment tax, which is Social Security and Medicare. And you have to pay your half, and you have to pay the employer's half. And guess who the employer is? Yes, that's you. You have to pay 15.3% on top of income tax. So if you're in a 20% tax bracket and you have to pay 15.3% on top of that, right? 35% of your income is going to taxes. So if you find $100 of deductions, you just saved yourself $35. So it's really important that they understand that and they get that. So that's, and as I said earlier, I see more people get sideways with the IRS because they went through the whole year. They made a chunk of money, you know, they made $20,000. And yeah, they kind of knew they were going to have to pay income tax and they'd have kind of a bill, but you know, they don't make that much money. Their bill's not going to be, and then full. They made $20,000 and there's an extra $3,000 self-employment tax. I can't pay that. And they get in trouble. And that's, you know, that's why, and okay, I'll spare you the information about what makes you an independent contractor or not, because that's kind of beyond what we do. But it's kind of sad that some of these folks get trapped into this sometimes if they shouldn't. So here again, taxpayers must be prepared to provide receipts and other documentation to support their claimed business income and expenses here in the event of an IRS audit. We don't have to see that. We can take them at their word as long as we feel that they're being reasonable, that they've actually reconstructed or calculated at it is. But here's the second place. I almost always right here remind these folks that they are responsible for what's on the return. You know, this is a great place to do that. We see a lot of Uber and Lyft, and that is business income. Now, here's kind of a difference is that business, they don't get the 1099 NEC. Instead, they get a 1099K. And the 1099K is really designed to be income reported on credit card payments. Like really what they put this in place for is people who were selling stuff on eBay and Craigslist and that if they were like running a business on there, then Craigslist or eBay had to send them a 1099K saying, hey, you received all these credit card payments, right? You better, and we're going to tell IRS about it, so you better account for it somewhere, right? Well, you know, Uber and Lyft, that's how all the income comes is on a credit card, right? So they give them a 1099K, but they're pretty good about it because they'll give them the 1099K and then down in the bottom, they've also tracked their mileage too, which is really helpful sometimes. So I'm going to show you here how we report that too. Yeah, so this is called 1099K is payment card and third-party network transactions. Like third-party network is the Visa and MasterCard and stuff like that. Here again, taxpayers may not receive the 1099K if the income was less than 600. That does not mean they don't have to pay tax. And if they tell you about it, you can't just ignore it. Okay, you know, you can't ignore it. Okay, you can try to help them identify expenses that reduce their tax liability on that, but you can't ignore it. This is what the 1099K looks like, although it can take different forms. I think the Uber and Lyft ones don't really look like this, but they have the same box number, so there. Now, let me take a drink of my thing because here's the other expense that I will tell you right now, it's a pretty low percentage of returns that get audited, and especially in the income area that we're talking about. But the things that will increase an audit, number one is this, there's a Schedule C. It just opens up, a lot of people cheat on that. They deduct their Home Depot purchases that they were using for their yard and call it, supplies on Schedule C. And IRS knows this. Second thing that then especially when they see the Schedule C, they're going to look at auto expenses because people tend to over deduct on auto expenses. The third thing that they look on is home and office expenses, which we're going to find is out of scope for us because that can get complicated and they look at it. But right here, we're going to talk about auto expenses. And there's a really important concept I want you to understand about auto expenses. And this is just in general. You all have worked for people, right? I work for Scottsdale Community College. I live 24 miles away. I drove 25 miles to work and 24 miles back. Did I get to deduct those expenses? Nope. That's called commuting. You don't get to deduct the expense of driving to work. Now, I drove to Scottsdale Community College, and then if I went to go do a tax return, that mileage that I went to go visit the client, that's deductible on my Schedule C that I have for taxes, okay? And then if I drove to see another client, well, that's deductible. But then I come home. That trip's not deductible. That's called commuting. The general rule is your first trip of the day away from home is called commuting. Your last trip of the day on the way home is called commuting. And when we claim these auto expenses, and here's the second place I usually get to tell people that they're responsible for everything on the return. There's 3 little boxes on the back on the actual tax form and the taxpayer signing it. And if they've claimed auto expenses, it says, hey, do you own another vehicle that is this vehicle used for personal use, right? Yes or no. If you're deducting these expenses, do you have a record of those expenses? Yes or no. And if you type no, it's non-deductible. Third is the record a written record? And if you type no, it's non-deductible. That's what the tax code says, is that to be able to deduct deduct auto expenses, you have to have a record, and that record has to be written. So then now the good news is for these Uber and Lyft drivers, of course, everything's being done using GPS, and Uber and Lyft will report what their mileages was while they were driving, for Uber. The question we need to ask them is about that first trip of the day, going to the first pickup and coming home from the last pickup, unless they left directly from work, right? But driving from home is not deductible. Driving to home is not deductible. It's called commuting. And on the tax form, we've got to identify what the commuting miles is, and they've got to recreate a record, and it has to be written. We don't have to see it, but they have to have one if they get audited. And I've been through these audits, and they ask for them, and they'll just disallow the deduction completely if they don't have it. So I'm sorry, I didn't go over this. So what is this saying? Daryl used his car only for personal purposes during the first 6 months. During the last 6 months of the year, he drove the car a total of 18,000 miles. Of those miles, 15,000 were driven to provide transportation through a ride-sharing service. So this is assuming he's got a really good record of it. He's not counted his commuting mileage or his other personal miles in this. And so the question says, in this example, Daryl can deduct the 15,000 miles using the standard mileage rate, as well as any other, and here's the tax term, ordinary and necessary business expenses. And here it gives it a couple of examples, such as supplies, a cell phone. Oh, whoops, be careful here. A cell phone. Now, does he use that cell phone for personal use? Personal use is not a business expense. And if he does, you've got to allocate the cost between that. Now, if he says, no, I got my personal phone over here, and this is my cell phone I use for business, purely. Okay, good. It's 100% deductible. No problem. Food and drinks for the passengers. Now, he's buying this, bottles of water to keep in the car. That's deductible. Parking fees, tolls, roadside assistance plans, insurance, taxes. I would ask them, I tell them this general thing, think of anything you bought that helped you make money doing this. You know, in the olden days, this isn't anymore, but if you were doing this kind of work, you probably want one of those Thomas maps, right? And, you know, you guys are probably too young to even know what I'm talking about, but, you know, you'd want a map of the city, right? So you get around. Now you just use GPS in your thing. But the point I'm trying to say is, oh, here's a good one. Is, okay, he's got to track his mileage. And here's the easy way to do it is there's apps you can buy to track that mileage. And there's even apps with a little USB thing that you can plug in to your thing to where it recognizes when the car takes off, right? And it even recognizes where it is. And you can have it, that makes a perfect mileage log for it. And it helps you track your commuting. Now you have to pay, some of those are free, but I have one that I paid bucks. That's a business expense. That helps me keep track of my accounting records. Oh, I'm going to really do what Jim told me to do and track my expense. I'm going to buy Quicken so that I can have a really good record of that. That's a business expense. Good. Okay, so you get the idea. Let's see. I'm seeing Jennifer. Okay, I'm seeing, and I forget Betty. No, I forget what her name. It doesn't matter. Somebody asked, "What about a car wash?" And that's a really good question because people were deducting car washes. I mean, geez, I mean, if I'm driving Uber and Lyft, I want my car to be clean when I go do it. But IRS issued a temporary regulation last year that said car washes aren't deductible. Okay, so the answer is no. That's generally, I used to deduct them. I used to tell them, yeah, but IRS came back and said, no, you're getting personal use out of that. And nobody's taken them to court yet over it. Then somebody else, Beth had asked about that. And then Jennifer asked, do you have to do a percent of insurance, et cetera, since the car is partly used for personal? And the answer is yes. Okay. However, and I got to think about this. No, insurance, yeah. So you come up with that mileage. I drove it 12,000 and 6,000 is for personal and commuting use. I used it 50% for business. I can deduct 50% of my auto policy on that. Most of the other expenses with a car, you're going to find we take the mileage for it. And mileage will include most of those things, but it doesn't include insurance. So that's why I'm answering Jennifer that. But most other things like cars, maintenance, I mean, tires, maintenance, gas and oil, all of those things are in the mileage rate. And the mileage rate is really generous unless you have a very expensive car. And oh, by the way, there's a choice. IRS says, hey, you can take our standard mileage rate or you can use actual expenses if you can justify that they're more than the mileage rate. If they choose actual expenses, we cannot do the return. It's out of scope because they have to depreciate their car that way. Then we don't do depreciation. Okay. I got to watch my time here, see where I'm coming. So here's the input screens for TaxSlayer. Now there's an input screen for the 1099 NEC. And so you would pull that up, you'd put it in. And if there was anything in this business that came from the 1099 NEC, it would come in here. But this is the example for an Uber or Lyft driver. Now you get there is no TaxSlayer input screen for a 1099K. If they show you a 1099K, well, and it says right here in TaxSlayer, including other gross receipts or sales, including income reported on Form 1099K. You know, this person may say, oh yeah, I also kind of ran a little limo service, you know, outside of Uber and Lyft, and I would charge money. Okay, well, you got to come up with that income, and we would have put it in right there on that thing there too. Then any other cash income you can put right here. This would be more like tips that you would put in right there. Now, the Uber and Lyft drivers, usually their tips are reported on a credit card. That doesn't mean they don't get cash tips, and you should ask about that. They should report those cash tips. As I said before, The business expenses must be ordinary and necessary. Here's some good examples: cost of goods, cost of labor, office expense, commission and fees, repairs and maintenance, supplies, telephone expense, anything that you had to spend to help you make money at that business, as long as it's ordinary and necessary. I'm trying to think of one that wouldn't be ordinary and necessary. Well, okay, lavish entertainment. You take somebody, one of your clients, and you say, hey, let's go to Europe. Do that. No. Another thing that you're going to find is not so much with Uber and Lyft things, but food and beverage expenses. In general, since the Reagan Tax Act back in the 80s, you could only deduct 50% of food and beverages. Like that. In other words, you take a client out, and there's a lot of substantiation rules for this, documentation rules. You've got to have a record of who you took out, how much you spent, and on what, and what the business discussion was. It's pretty easy to document if you're using a software like Quicken or whatever, but that's what the rule says. And up until last year, the expenses were only 50% deductible. But then because of COVID that came on, they got it up to where it's 100% deductible for 2020. And I think it's still 2021. I'm not sure. Gene, do you remember? Did the 100% deduction stay for 2021?
Yes, it did.
Okay, good. Some of those things that came in for 1 year, like the unemployment thing, didn't stick around for 2021, but that one did. Okay, so I got 10 minutes left. Let's see how we're doing. This is kind of a graphical description of what I talked about, that commuting thing. So here's your home. You drive to your work location. That is that's only deductible if you're coming from your regular or main job to another work location. Okay, then you go to your regular job, that would be deductible. You go to a second job, that's deductible. But when you drive home, it's never deductible. That's commuting. I'm going to leave it at that. That's the easiest way to think it. First trip of the day, last trip of the day, it's not deductible. In between, if it's business, it is. If if you're the Uber driver and you go to lunch, technically that's not deductible. They should account for it, but okay, I'll leave it. All of the following are deductible businesses on Schedule C, except, and you know what? This is nothing I've covered, and it's almost getting kind of outdated, so I'm going to tell you the answer right away. It's a landline telephone cost. And here's what IRS came out and said, is that if you're working at home, the first line into your home is never deductible no matter what, whether you use it for business or not. These days, we're kind of all using cell phones, and I'm waiting for the day for them to come and say, oh, the first cell phone's never deductible. The second one could be, but they haven't done that yet. Right now, though, you should allocate a reasonable percentage. And, there's no specific rules about it. I'm just saying, if you get audited, they're going to look at that and they're going to say, oh, is that phone used 100% for business? And if you say yes, they're going to start digging into all kinds of stuff. But if you're just reasonable about it, 30%, I'm not going to put a percentage on it, but you ask them to put a percentage on what's personal and what's business, and you only deduct the business use of it. All of these other expenses, and by the way, expenses paid for the business use of the taxpayer's home, that would be deductible, except in VITA, that's out of scope. But you can have a home office expense. There are a lot of rules. And as I told you, that's about the third most thing that IRS will look at if you take a home office deduction. That doesn't mean that they shouldn't take it. And if they're entitled to it, you may want to convince a taxpayer, maybe you shouldn't be using VITA. Maybe you need to go to a professional tax preparer. However, between me and you, professional tax preparer that's doing a Schedule C with home office, that return's going to cost somebody $400 or $500, right? And the value of that home office deduction is not that big. I mean, so whatever. There's also less common income that we're going to run into, most of which is out of scope, but we're going to find, and this is common, we're finding a lot of people with gambling winnings that get reported on Form W-2G. K-1 earnings. This is when somebody's a partner in a partnership, or they're a member of an S corporation, a shareholder in an S corporation. We can do simple K-1s. Not going to get very complicated about that. Usually if you see one of those, it's good to have the site coordinator take a look at it to make sure we're not doing something out of scope. But if it's just a simple one, we can do them. Here's what we see for a W-2G. And here's where it shows reportable winnings. It'll say the type of wager. Always watch for federal income tax withheld. And there is a screen in TaxSlayer that where we can put these things in. Of course, if they give you a Form W-2G, what do you want to ask them? Oh, did you have any other gambling winnings? And hint, hint, there's going to be one of these on the tax returns that you do, right? Just because it didn't get reported on a W-2G doesn't mean it's not taxable, okay? Here's the input for the gambling winnings, where it'll tell you, you put in the gross winnings. I guess this doesn't have the box numbers on the W-2G, but it's pretty self-explanatory, but look for the red asterisks, because those are required things. You're going to have to tell it what kind of gambling it was. Let me see where I am at this here too, because I don't think I'm going to be able to finish. Yeah, we've only got 5 minutes right here. Sorry if I'm giving you a headache here, but I think what I want to do is stop right here at scholarship income, because this is something we see and it's kind of complicated in that. And if you get a good grasp of this, when we get into the education credits, it's going to be a lot easier. So I think we're going to pick up with this tomorrow morning when we start off.